I think where the Chinese yuan is concerned, we are actually very positive about it, and we do think that it might actually reach about 6.7 by March next year. And that hinges on the fact that the economic recovery in China is far better than the other countries that we are covering at this moment, particularly the US and Europe. The exports have remained strong, and as a result of that, that basically means that the inflows on the current account are actually higher than expected. That is likely to actually underpin the strength of the Chinese yuan going forward. On top of that, we do get the sense that a lot of the exporters who still have a lot of the uncovered or unhedged US dollar positions are likely to actually sell out of these positions to try to actually make sure that they do not suffer from the impact of a weakening dollar going into 2021. So if you combine all those factors together, we do think that the Chinese yuan is likely to remain resilient and perhaps actually strengthen all the way to 6.7 by March next year. Now, on top of that, the Chinese yuan and the A shares actually do have quite a strong correlation. That correlation broke recently, but we do think that that should actually come back into play in the near future. And that basically means that for the A shares, that is likely to be another strong buying factor.
Right, and with this retail sales data looking positive, are you more upbeat about the consumption story bouncing back in China?
Absolutely. I think the consumption is one of the last vestiges where the Chinese economy has not really come back to the pre-COVID-19 levels yet. But we do think that consumption is likely to pick up quite considerably going into the end of the year, especially when most of China have actually been freed from the circuit breakers or the lockdowns since then. You don't even get people wearing masks on the streets anymore if they don't want to. So that in turn is likely to be quite positive for consumption going forward. And we do think that consumption will likely pick up stronger towards the end of the year, going into the Chinese New Year period in the first quarter of next year.
Right. In your conversations with clients, Kelvin, how worried are they about US-China rising tech tensions and the implications this souring of the relationship between the two countries can have on tech supply chains in the region?
Yeah, I think that's been largely on the back of their minds since last year, actually. But since the COVID-19 pandemic broke out, the COVID-19 has rightly actually assuaged concerns and has actually taken the priority where your investment concerns are considered. But I think in all things considered, a lot of the clients are actually holding the big five FANG stocks in the US. They're also holding the software-denominated consumption stocks in China, and these have basically nothing very much to do with the supply chain. In other words, if trade tensions worsen between the US and China, and if there are more tariffs coming in, these tariffs are not likely to affect the cash flows or the net profits of the domestic Chinese companies that these clients are actually holding.